Hey everybody, welcome to this free edition of our Trader User Group, a weekly roundup for the trading week ending March 25th, 2022. I'm Preston Brent. Thanks for tuning in. Well, blast off to say the least for the markets. Got a lot to review on this short weekly roundup, so let's get right to it. How about it? So if we take a look at the index performance for this past week, you can see everybody was in the green with the exception of the Russell. Everybody's moved out of correction territory year to date. The worst performer is still Nasdaq with the rising interest rates. Tech stocks just do not like rising interest rate environment when these things start to kick off. We've also seen this week government bonds on pace for their worst start of the year since 1949. Investors are looking for other places to put their money, I suspect. So that's why, even though all this bad news came out from the Fed and inflation and everything else, money just kind of settled and nowhere else to go but stocks. Equity markets, as you can see, ended mostly higher. The market was subdued during the trading day, but there was a strong buy on close trend through most of this week. In fact, Bloomberg reported that the S&P had gained 1/3 of 1% in the last hour of trading for 5 consecutive days. That's the longest streak in 20 years. So, and we've seen the S&P up now over 8.1% over the past couple of weeks, 10 trading days. This is the largest rally we've seen since April of 2020, coming out of the pandemic back in March of 2020. And we also saw this week in a very increasingly hawkish Fed has prompted a sell-off in the bond market, driving the 10-year Treasury up to just slightly under 2.5% at 2.49%. You can see the trailing PE ratio in the upper right-hand corner of your screen at 24.78. But look at the forward, 19.85, still a little bit elevated. 10-year Treasuries you see up there at 2.49. It's over 1.1% higher than the dividend yield. The earnings yield for the S&P is at 4.52. The real yield, when you factor in inflation, though, is a short 5.87, still very ugly. So money is still going to flow into the equity markets, I believe, until we get a little bit of a capitulation. The VIX continues to fall. Last week was at 23. The week before is at 30. Now it closed this week at about 20.81. So it's down 12.8% for the week. Best performing sector, energy, up a strong 7.61% year to date, strong 38.47. Worse for the week, healthcare. Worse for the year, communication services. So we're starting to see some improvement. Some of the stocks working off some of their really horrible charts. We did see from the economic data standpoint, I'm seeing a little bit of weakness coming in. Durable goods fell a little bit in February. It was the first decline in 5 months. Okay. New home sales declined a little over 2%. 30-year mortgage rates moved up to about 4.85%, which obviously is going to it's going to dampen some of the demand for new homes. Although housing makes up about 40% of the CPI, that's the inflationary data. And because rent prices follow house prices about a year down the road. So we can expect housing to continue to push inflation up. And housing also is about 20% of the U.S. GDP. So we're going to be affected by inflation for quite some time. Okay. In the corporate bond market, liquidity is not as strong as I'd like to see. Again, these hawkish comments from Boom Boom Powell, technical conditions kind of drove up the rates. We're seeing, in fact, this past week I saw the Fed Fund futures rate price in several 50 basis point rate hikes over the next few FOMC meetings. The next meeting, by the way, is May 4th. Is when we get the press conference. There's not going to be one in the month of April. And then we get another one in June, actually June 15th, we get another press conference. And both of those, the Fed Fund futures is pricing in 50 basis point rate hikes for each one of those, assuming inflation and the CPI doesn't come down near term, which I do not think it will. So that's a little bit about what we're seeing there. Slowdown in the economic growth. inflation getting stronger, interest rates going higher, yet markets move higher. All right. I think we're going to start to run into some trouble here in a minute. I'll show you the charts. And of course, if we go across the pond, and let's just take a look at Europe, you can see in Europe kind of a mixed bag. The FTSE and the DAX were the only two in the green for the week. Year to date, everybody except for the FTSE is in the red. The Euro stocks, which is the 50 largest companies across Europe, they're in official correction territory. We would naturally expect Europe to be underperforming only because the issue or the invasion into Ukraine, that's in Europe's eastern backyard. So they're going to suffer a little bit more than we would over here. Plus, they've got energy constraints because they get a lot of their energy from Russia, especially nat gas. So that's going to be difficult to unwind. They've made it a stated objective to do that, but they got caught flat-footed. They were warned several years ago by Trump at the time, but they just kind of ignored those warnings. But that's kind of what we're looking at. Business activity in the Eurozone also slowed in March. Their PMI fell a little bit in the month of February. Business confidence also was going a little bit lower. Meanwhile, over a little bit further west in Great Britain, the UK, their inflation hit a 30-year high in February. The Bank of England, which was one of the first G7 countries to start, or with central banks raising rates, they raised rates for a third time now. And it's going to put more pressure on them, right? Their CPI came in at an annualized 6.2%. That exceeded their forecast of 6%. So they're having their issues. I mean, it's like the sun and the moon and the stars all lined up, especially with the high inflation being made worse with this invasion into Ukraine and a cutoff of some of the supply chain issues. So we're seeing some of that just really kind of pull itself through the markets. And if we go over the Asian markets, you can see in Japan, they had a strong week. They're still underwater for the year, but a strong week, up 4.93%, as you can see in the lower left-hand corner of the screen. But their sentiment is being boosted by expectations of further economic stimulus by the Bank of Japan. There's only two central banks putting money back into the economy rather than taking it out. And those two are Bank of Japan in the Asian markets and China. So the Bank of Japan, they maintained a very accommodative monetary policy. We did see the CPI in Japan go up just a little bit. PMI data showed private sector activity fell just a little bit, but more money in, markets love that. And then, of course, in China, the markets fell. There's more delisting fears for U.S. listed Chinese companies. Be very careful if you're holding BABA, JD.com, some of these Chinese ADRs that are listed on New York Stock Exchange, because essentially there's a bilateral dispute on auditing standards, and the SEC in the U.S. is putting their foot down, and they want to do a little bit more thorough audits of Chinese companies listed in the U.S. And of course, China doesn't want them to do that because I think a lot of their data is smoke and mirrors. So they could be delisted and moved to the Hong Kong exchange. Now, it's not going to happen overnight, but just be very careful in these stocks, okay? Meanwhile, the other thing that's kind of got China down, and you can see Hang Seng also in the red as well. China's in official correction territory. Out of all the major ones that we follow, China and the Euro stocks, the 50 largest companies in Europe, are the only one sub 10% year to date, okay? And there is reports of a worsening COVID outbreak in mainland China. So that's kind of moving the risk appetite even lower. So that's what's going on over in the Asian markets. Now, what I want to do is flip us over and let's take a look at the charts here real quick, just to kind of give everybody a perspective of what's going on. I'm going to switch you over to the E-mini S&P 500 futures. Following the screen, you're going to see here when it comes up there, I've got a regression line down. You can see we broke out just as we took over that yellow line, which is the 200 EMA. And you can see the red line, which is the 50 EMA. Both of them now started an upward vector. You can see we're in this overall resistance zone here that runs up to about 45.50. But for me, we need to clear this key prior pivot high, sitting right at 45.86. If we cannot clear that and hold it, the odds favoring us coming back down to around the 4,400 level to test the 200 and or the 50 or perhaps both EMAs. Okay, so that's going to be what I'm going to be watching for. Really strong move off the lows. You can see we're still in the red for the year. Like I said, we're in the red by about 4.68%, roughly, call it 5%, in the red for the year. So, and the all-time high in the S&P was made on January 4th. Now, I said this looked like a bear market chart. It looked like the 50 was going to cross below the 200, but then this sharp reversal, very fast reversal, which is really, like I said, we gained over 8.1, a little over 8% over the past 2 weeks. It's the biggest rally since April of 2020 in the S&P. So that really forced the 50 EMA back up a little bit and the 200. So that's where we're sitting here. But this is the key level, guys, 45.86. Take out these prior pivot highs and hold them. I want to see that happen. Then I'll be a little bit more confident that we'll be able to move back into the green. I'm seeing market cycles showing where we can kind of finish out the remainder of Q1 in a neutral to slightly bullish bent, and then we're going to start to give back some of these gains in the month of April. Also understand that by week 2 in April, we're going to start getting into earnings. FactSet is already putting out that we're having a higher than normal earnings revision down for Q1. And understand the year-over-year comps are going to be harder now because now we're comparing Q1 of this year to Q1 of last year. So the comps are going to get harder and harder to do, coupled with rising interest rates, very high inflation, and it's going to be very difficult for price action to continue higher. The only thing that's going to move it higher, two things. One, we have very strong earnings or surprise to the upside in earnings, and we look like there's going to be some common ground in a negotiated settlement between Ukraine and Russia. Now, I think we're going to eventually get there, and that'll bump the markets, but it'll be a short-term feel-good bump before the markets go back to the economic data and earnings, which I think are not going to be that good, and it's going to put some downward pressure on the markets. Now, if we come over here and look at the Dow Futures, you'll see everybody's had a pretty good run, right? And the Dow Futures, the 50 has crossed the 200 to the downside. And we're barely holding this. So we've got to pay very close attention to this. Understand the Dow, the S&P, Nasdaq, and Russell tend to go together. One will always lead the other. Typically, the Russell leads the other indexes to the downside coming out of a bull market and a bear market leading to the upside. Nasdaq has been leading the way for the past 10 years, actually coming out of the a little bit more than 10 years, 13 years, actually 12 years, coming out of the 08, 09 great financial crisis that we had because of low interest rates. Now the regime and the markets are starting to change and shift. With that shift, you're going to see different sectors, different asset classes performing better than others. And no longer is it going to be a free ride in the tech. Just buy any tech and you're going to make money. That's going to shift. So we've got to watch all of these for clues of which way the markets want to spin themselves. Okay. But again, we're underwater in the Dow as well, roughly about 4%. Dow's a little bit better underwater, not as far underwater as the S&P. Now, if we go look at Nasdaq, that's under just slightly under 10%, a little over 9%. So if we look at Nasdaq right here, it was the only one that finished down on Friday. But if we look at Nasdaq, notice here again the 50s crossed the 200. We're barely hanging on to the 200 EMA right here with Nasdaq. So I'm watching the Nasdaq as a little bit of a degree of risk in the market. If Nasdaq rolls back over, risk is coming out of the market again. I'm then going to watch to see how we perform in the Dow and the S&P. If they roll over relatively hard along with Nasdaq, that means the money's not being allocated back into value and dividend type stocks out of growth. They're going back into bonds, all right? And we may get a little bit of a lift in bonds. So that, and then if we look at the worst of the indexes, which is the Russell, look at the Russell, guys. I mean, it is barely hanging onto the 50 EMA. We crossed the 200 EMA, called the death cross, back in the end of last year, early this year. So, folks, that's a bearish chart right here. All right, that is a bearish chart. Same thing with Nasdaq. It's a bearish looking chart. We cannot have two of our major indexes, Nasdaq and the Russell, looking more bearish than with the S&P and the Dow. You know, relatively weak looking. So the odds over the next 60 days still favors more downside action. All right, that's what the odds favor. We need to see some repair across all these index charts and price action for me to get a little bit more confidence. Okay. Now, if we come down and look at volatility, volatility did come back down a pretty good little bit. Look at this. We were way up here and we moved back down. We're still in a slightly light red zone. So we're still in, markets can move down very quickly. But that's kind of where we're sitting. Now, just as a reminder, for those trading VXX, some of you that follow it very closely may have noticed VXX has not fallen as much as it should based on the move lower in the VIX. And the reason why is Barclays, which manages VXX, has stopped issuing new shares, which means the share price is going to stay up higher than it normally does. It normally has a negative roll yield to it, but we're not seeing any of that. So this is going to be a very tricky index to trade, or it's an ETN, not an ETF. And with an ETN, exchange traded note, about every 10 years or so, that's kind of how they do it. They have to completely file and do it all over again, right? Unlike an ETF that has an unlimited lifespan, an ETN does not. It's got a limited life, and then they got to file all the paperwork again to re-up the 10-year thing, the lifespan of this ETN. So be very careful when you trade this. In fact, we've had a strategy that works extremely well with VXX. We were, I think, 11 out of 11. And now we're in this one. It's not working as well. And because Barclays just came out and announced that, and they didn't say when they're going to start issuing new shares in VXX. So it's not performing as it should. So we're probably going to stand on the sidelines and wait until Barclays comes back in and see what they have to say. All right. But net, volatility is down dramatically. I mean, we were literally, we were up here around 37 on March 8th. And then we spent the rest of March with VIX just coming down pretty hard and coming out of the markets. All right, we're still elevated at 20.81 because we're above 20. I'd like to see it get back down in this level down here. We'll see where we go with that. And of course, if we look at the bond market, right, you can see the bond market came down, and actually my target for bonds was right around 144.26. And the low here, I've got to move this thing down, was 146.20. So if I come in here and do that right there, that was the low, almost between time and price. Now, if I put it on a monthly chart, let me just see how far out I can go. This is the 30-year bond, all right? You can see on the 30-year bond, we were up at 191 back right before COVID hit, and then we've just been working our way down. We're hitting my target right there. There's a longer term target of 136.18. I think we're going to slowly take that out, not without some choppy moves to the upside, but that's kind of what I'm seeing here in the bond market. Now, our members that have been following my trade advice on this have done very well, okay? Every time bonds has rallied, we've been shorting the bond market. I've been recommending shorting the bond market. It's $1,000 a point in the futures market, or you can do broken wing butterflies or unbalanced flies, and any one of these would work very well, or just trade the ETF that plays that. Members, we'll go through that in our weekly market watch tomorrow evening. And of course, if we come down and look at currencies, right? The reason why the dollar is still holding up very strong, even with interest rates on the move, like the German Bund is up above zero again. The reason why the dollar is holding up very strong is Europe sucks right now. Their economy sucks. They got the issues with Russia on their eastern flank and Ukraine. They're running gas prices there are just insanely high. Nat gas is insanely high. Food costs are going to go through the roof there. So the dollar is kind of a flight to safety kind of thing for now. When things start to settle down, you'll see the dollar come back down, or the dollar index come back down, but not right now. And if you look at the euro, you can see we blew right through my projected level, and we're now sitting at about a 110 to the dollar, right? So if you got to go to Europe, this would be a good time to go. Right? That's kind of what we're looking at right now. And then, of course, if I come down here and look at gold, I think longer term gold is good. This move here was just because of the immediacy of the when Russia moved into Ukraine in that invasion around the 24th of Feb, gold just took off and now it's settling back in. If they have a negotiated settlement, gold will settle back in again. I think longer term is going to move a little bit higher. There have been I've recommended other trades in the precious metals market, and members will go through that this weekend, that I think have a higher probability of being successful than just pure gold. But there's other ways to trade gold right now as well that I think will work out nicely for those of you that, and we'll go through that members Sunday as well in our weekly market watch. Okay. Energy, oil. Well, we got some trades on playing oil as well. You can see oil is sitting at $112. I think longer term oil is going to settle back in below 90 in the mid 80s, but not right now. You can see where buyers just stepped in at the 50 EMA. It's going to hold up here, but there's a great way to trade oil as well. Understand when they have a negotiated settlement, which hopefully they'll be able to do in the next 2 or 3 weeks. You're going to see oil fall anywhere from $5 to $10 a barrel real quick, and you'll see a lot of volatility come out of the market. You'll see the S&P E-minis run up pretty good. That would be a nice shorting opportunity once it spikes from that kind of news event, and then things will start to settle back down a little bit. But there is oil here. I think it's going to have a hard time holding that level right now. Now, according to the sanctions and whether Iran comes back in and gets their oil in the markets, I think oil is going to stay bid for the short term. All right, nat gas, same thing. We've got some plays in nat gas. You can see it's slowly moving up. It's not spikes like this. It's just moving up slowly because the U.S. is going to start providing some nat gas, liquefied in LNG over to Europe over the next, contracts are being signed if they haven't already been. And we've got some plays on to take advantage of that as well. So members will go through that in this weekend weekly market watch. So that would be nat gas. Folks, that's kind of where we're sitting right now for our markets. If you're not a member, I highly encourage you to come in. We're doing really well. We're making great money this year. I think it's going to get even crazier as we go through this year into 2023. I'm forecasting over the next year and a half or two a huge bear market, and I don't know when to predict the timing of it, but we're going to get wind of it. And when it hits, that's when you can make some really good, serious money. And we'll show you how. I'll show you how to not lose money in a big bear market, rather make good money. All right, everybody, have a really great weekend. March Madness is here. We're getting down to the Sweet 8, and then the Final Four. Should be a lot of fun. Our Miami Hurricanes down here in South Florida are doing pretty good, but I think they play Kansas, so it'll be a tough game. Have a great weekend, everybody, and I will see you members Sunday evening for our weekly market watch. Take care, everybody. Ciao.